Welcome back, my name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video we're going to be talking about PayPal and Starbucks' earnings, and they were disastrous. And when I tell you they were bad, I'm not exaggerating, particularly in the case of Starbucks. It was awful earnings. Perhaps some of the worst earnings that I've seen over the past handful of years that I've been in the stock market and I've been following companies. It was an outright disaster, and yet the stock was only down 6%. And I'm getting a bit ahead of myself here, but the reason it was only down 6% has to do with a certain CEO having the reputation that he has and having the track record to be able to man this type of ship despite the disastrous results that the company continues to put up. Additionally, the second stock that we're going to be looking at today is PayPal, which also had a pretty bad earnings report, perhaps not to the same degree as Starbucks, but nonetheless, the report wasn't good, and there's one key metric that I would like to look at that really clue us into the de-acceleration of this business and the current state of the company. But before we do all that, I would like to point to a video that I did about 7 months ago, and although the video is about Google, which has nothing to do with today's video, I promise, we've talked about them enough over the past handful of weeks, but more importantly, the specific thing that I want to point out is within the first 7 seconds of this video, where I'm essentially, I should probably mention, the gist of the video was that Google is such a great business, it's trading at such a cheap valuation that the opportunity cost of owning anything else or any of the turnarounds or any of these companies that are like supposedly cheap stocks or whatever the case may be, you might as well just own Google. And within the first 7 seconds of the video, listen to what I give as an example of these companies that are supposed turnaround plays that are cheap valuations, and yet the fundamentals are materially deteriorating. Things don't always have to be hard. Oftentimes I hear from investors that, oh, you know, with Starbucks, things are going to improve. Brian Niccol's coming in as the new CEO and things are going to change. They're going to turn it around, the China expansion, this and that. There's too many working parts, frankly, going on in the story of a business. Or, for example, a stock like PayPal that I also used to own once upon a time. Again, brand new CEO coming in, all these different buybacks they're doing. They're going to be able to re-accelerate growth, among a slew of other things. Within the first 30 seconds of the video, I'm talking about the two turnaround plays, PayPal and Starbucks, which at the time, and of course, nobody could have really predicted this, but I was making the case of there's likely more trouble for these type of businesses, and that's actually why I sold both these companies over the past, year and a half, whatever the case may be. And full disclaimer, I used to be a shareholder of PayPal and I sold at a small loss. Same thing goes for Starbucks. Again, I sold at like around a 10% loss. And so with that, we're going to jump over to finchat.io, which is the sponsor of today's video. If you've been on the fence with a FinChat subscription and you missed the Black Friday sale, here's your only other chance to grab FinChat at a discount. They're currently running a 25% off spring sale on all paid plans. And of course, if you've been watching the channel for any amount of time, you know that I use this software religiously, and I'd love for you to gain access to the same tools that I use in my research process. The sale ends on Thursday, May 1st. And if you'd just like to try it out for free, there's a 2-week free trial using the link in the description down below. Speaking of, we're going to be using FinChat to showcase to you the disastrous quarter that Starbucks just had. And of course, one of FinChat's main selling points is of course the segments and KPIs, which are aggregated on over 2,000 different companies. In the case of something like Starbucks, we can really get down to a granular view of, for example, the first metric that we're going to be looking at, the North America operating income percentage change. Bit of a mouthful, but I'll walk you through it. And so earlier when I told you that, Starbucks had a disastrous quarter, this is exactly what I was talking about. Operating income, which I'm sure many of you are very familiar with, is done a little bit differently in the case of Starbucks because they show you the operating income on a geographic level. So for example, North America, I believe they have Europe. No, it's just in North America and international, but then they have a huge negative number in terms of corporate operating income. That's just forever going to be negative because obviously your corporate headquarters where you have all your corporate employees and that type of stuff, that doesn't actually generate any revenues. So technically any expenses under the corporate segment is just going to flow down to negative operating income. But basically, if you work the numbers back a little bit, if you exclude that corporate negative operating income headwind, in terms of the quote-unquote profitable segments of Starbucks, the North America segment historically has made up about 3/4 of operating income. Out of every $4 of profit that Starbucks makes globally, 3 of those come from North America, which makes sense. North America historically has been where they've had their largest footprint, and additionally, they're able to charge the highest prices. Obviously, the North American consumer is a little bit wealthier and is willing to transact at a higher ticket price, in a higher frequency, so on and so forth. You guys get the idea. What if I told you, at least on a quarterly view, the North America operating income has declined by more than half since its peak in October of 2023. Now, of course, that's maybe an unfair comparison given the seasonality, maybe the summer quarter, which the October quarter is basically the summer quarter. Maybe that quarter is a little bit more profitable for them, so on and so forth. But even comparing to a year ago, during Q1 2024, which by the way was on depressed earnings, the operating income of Starbucks has declined 35% year over year. I seriously cannot understate how awful that is. And mind you, this is not a one-off quarter. This isn't a thing of they're making massive investments and then next quarter it's going to pick back up, whatever the case may be. This is coming off the back of 2 quarters of negative declines, March of last year, June of last year, and then the 2 most recent quarters were negative 22% declines in operating income, and now we have negative 35% operating income on a year-on-year basis. And so because it makes up such a large portion of the operating income of the business, once the data loads in, it's probably going to be around the same number. It's going to be about a 30% decline in terms of operating income for the business. So naturally, you would think that if the profits of the business have declined by 1/3, the business, all other variables being equal, which of course they're not, that's kind of where I'm going with this, the business, the valuation of the business, the price of the company, the stock price, that should realistically decline by about 1/3 in order to maintain the same ratio there. Now, of course, the stock is only down about 6% because there's other variables involved here. Mainly, this decline in operating income is probably going to be temporary, and it's a result, and I actually listened to the first half of the earnings call in preparation of this video, but it's a result of them having increased investments into the business. And so we're not going to go fish for quotes in the earnings call and read through together and waste another 10 minutes. Instead, what I'm going to do is I'm going to simply ask FinChat Copilot, what did Starbucks say about increased operating expenses? And we're going to let the Copilot do its magic. I'm going to remind you in the meantime that this is, again, another great feature of the FinChat platform. You're able to get a Copilot that is specifically tailored to financial content and earnings call materials and is trained on earnings materials. So you're able to ask it questions like this, and it's able to retrieve that data in an accurate and summarized manner. So in the case of our prompt, it mentions how operating margins were 8.2%, which declined by about 4.5% year over year. This is the reason why the Copilot's great. This contraction was primarily driven by deleverage and additional labor costs associated with the back to Starbucks strategy. And they mentioned this so many times throughout the earnings call. They mentioned how there's labor investments. So Starbucks strategically added labor to its stores to enhance customer connection experience. While this led to margin compression, the company views these labor investments as critical for capturing additional demand and transactions, which are expected to accelerate growth. So interesting. They're kind of painting this picture of they're putting down these investments into, by labor investments, they just mean they're just hiring more than normal because they believe that that's going to re-accelerate back growth. For example, if they hire more people, they're able to speed up the lines at Starbucks, which particularly in the morning rush. And then additionally, they're able to go back to, for example, writing the names on the cups and stuff like that. Additionally, they make mention of increased promotional and restructuring costs related to simplifying the global support organization also contributed to the contraction in operating margins. And at the same time, of course, I'm sure some of you guys know, but the price of coffee in of itself, the price of coffee beans have been extremely volatile, although they did make mention in the earnings call that they actually have a weighted average cost that is below that of the market. So just now I asked Copilot, what did management specifically say that they're going to do to address the poor financial results? Again, it's able to retrieve that information for me. They say that Starbucks is focusing on putting the customer at the center of their operations. This involves enhancing the customer experience and ensuring that their green apron partners, employees, are set up for success. Very interesting. They're calling them green apron. Anyways, they also made mention of a test and scale approach to optimize staffing and deployment, as well as order sequencing algorithms to improve throughput and the customer experience without heavy capital expenditures on equipment. They're actually pausing further rollout of a new expensive equipment and instead focusing on more labor-based solutions to drive throughput and connection. And I listened to the earnings call and they were talking about this. They said they're not going to do more CapEx, but instead what they want to do is by hiring more people and really focusing on treating their employees well. However they're going to achieve that, I have no idea. They're already seeing early signs of less turnover at the Starbucks locations that they're inputting these new strategies. They were very vague with what they were saying, and perhaps due to competitive reasons, whatever the case may be. And I actually think maybe to a certain extent they're kind of overpromising given how bad the results of the company were. But they were basically saying this sort of like test and scale thing of their main strategy for driving up efficiency in the future is that with the employees that they currently have, treat them better so that they don't leave as often and they don't have to deal with as much turnover. And turnover is really the evil of any big restaurant company or any big retailer or whatever the case may be. Staffing and having to retrain people and having new employees come in and make mistakes and that type of stuff is a very, very costly expense, particularly at scale. You know, Starbucks is a company that has probably, I'm actually not sure, but probably hundreds of thousands of employees, I would assume. Just searched it up, 360,000 employees. So there you go. If your turnover is 25% on an annual basis and you could drive that down to 10%, all of a sudden the churn on your employees goes from 90,000 per year down to 35,000 per year. And the delta there in between is way less people that you have to retrain, way less mistakes, whatever the case may be. You guys get the point here. Another thing that I actually kind of liked is they are rethinking the menu, although they haven't done much yet. They're obviously going to still bring back for example, the summer cold drinks and whatever the case may be, but they're rethinking it, particularly with the food and that type of stuff. They really do want to focus on the coffee and the culture of the company and all that type of stuff, which I like. I always like when companies simplify their menu. It's a short-term headwind to the revenues, but long-term simplifying the revenues. I mean, just look at Chipotle, for example, right? Like, very simple menu, and they've done incredibly well because customers, when they're in line, they don't really have to think things through and whatever the case may be. And another factor that wasn't mentioned in the Copilot, but I think is integral to the fact that Starbucks is only down 6%, is the CEO, Brian Niccol. And unless you've been living under a rock, this is the guy that has turned around countless restaurant companies at this point. I believe it's Taco Bell, Chipotle, and I'm pretty sure there's one more in there as well. But to give you an idea, this is the equivalent of Luka Doncic going over to the Lakers. He's the guy in terms of turnarounds, in terms of particularly QSR turnarounds, and just operational excellence, being able to make these big, large-scale global businesses more efficient, right? And that was particularly the tone that he had on the earnings call. So it's actually mentioned right here that he started out in Pizza Hut during the Great Recession. Later on, he got moved within Yum Brands because Yum Brands engulfs KFC, Taco Bell, and Pizza Hut. And I think there's actually one more brand in there, but they moved him over to Taco Bell. He became CEO of Taco Bell, and he did phenomenally there. Taco Bell in 2011 was a very distressed brand. Their sales were dropping. They had an ongoing lawsuit about the quality of their beef. It was a stagnating, cheap brand with poor quality and a horrible, damaged reputation with consumers, falling behind newer fast casual concepts, namely Chipotle at the time. And, within 18 months or so, he revitalized the brand, however he did it, and Taco Bell was posting 8% increase in revenues, right? Down from negative comps. And then later in 2015, of course, this is the more high-profile turnaround that he did. He went over to actually rival Chipotle, and Chipotle at the time had that E. coli outbreak, which sent the stock down, 75-80% in the matter of a year. If you literally pull up on FinChat the Chipotle earnings per share chart or the net income, whatever you want to pull up, right here is where he came in as CEO, where the company very briefly approached literal unprofitability. And of course, as you can see, Chipotle has turned into a wild success. I believe the stock at the recent all-time high was close to a 10-bagger since he became CEO, or since the bottom of this sell-off. So great track record with turning around companies and turning them into a wild success. And I say all that to bring it back to Starbucks, where sure, they have a great CEO. They seem like they had the right attitude on the earnings call, but I'm still very negative with the actual financial results of the company. They did outright mention on the earnings call that they don't think that the current fundamentals of the business are a reflection of what they're able to achieve in the future. But me being the skeptical investor that I am, it remains to be seen. I think Starbucks culturally and as a brand, as great as it is, they're facing a lot more issues than it meets the eyes. I personally wouldn't be rushing to buy shares of it today. The fundamentals, as I've demonstrated to you, are in outright free fall. You have other metrics such as the average ticket growth, which is like the average cost of an item being bought at Starbucks. That has been flattish to slightly down over the past handful of quarters. You have same-store sales. That's been negative for 5 quarters in a row. So very troubled business operationally. And I guess the point I'm trying to make with this is I think there's a lot more difficulty with this business ahead. It's not like this next quarter they're suddenly going to figure it out and Starbucks becomes a booming brand again. I would just beware of an optimistic turnaround story. Now, with all that being said, moving on to the more neglected child in today's video, PayPal. And I should briefly highlight my history with PayPal. I used to be a shareholder for probably under a year, but I held the stock. I think it was about a 10% position. I initially started the position at about $60. I averaged up, and then I eventually sold at a small loss at around $62 per share. And so the stock is relatively flat since. And the reason specifically, the reason I sold the company at the time that I did is I sold it to buy into Google at 132 per share. And my argument at the time was that Google at 132 per share is trading at like a 16, 17 PE. PayPal at the time, and you know what? We can pull it up. PayPal at the time was actually trading also at about a 16 PE. So my whole argument was, okay, I have this very, very dominant business in Google, phenomenal company. It's growing revenues at the time about 15% year over year. They have the cloud business, very diversified. They don't have, well, technically they have disruption risk in the sense of LLMs, but I don't buy into that argument. I've highlighted that in videos past if you want to go watch those. But nonetheless, very dominant business, definitely better than PayPal in terms of moat, quality, everything. And it trades at the same valuation. So twice the growth, way better moat, same price. And so I made that decision. It's worked out well since, but I'm not judging this based off of a 1 year view. I want to see over the next 3 to 5 years how that bet turns out. It's probably going to do very well. And so let's go over the good with PayPal. Part of the thesis with PayPal has always been the buybacks that they're doing. The buybacks that they're doing are supposedly so accretive because it's such a cheap stock. They're able to buy back 10, 12% of the business, all as well at the blue checkout company. And so the issue with that is that, sure, on a surface level, in terms of basic valuation metrics, they're very cheap. But I think what's going to end up happening is this is a business that has now started to outright decline in terms of revenues. So, and perhaps the best way I can showcase this to you is to put on the percentage change in terms of their most important segment, the transaction revenues, and then let's go over to a quarterly view. So there you have it. This, by the way, transaction revenues, the money that they make from people transacting, whether that would be somebody buying something online, people sending each other money through Venmo or whatever the case may be, anything, any sort of transaction revenue that isn't their, analytics segment, other value added services. I assume that's B2B revenue that they make there. All of that revenue, the core of PayPal that you know, it didn't grow over the past year. It actually slightly declined over the past year. And what I'm worried is the trend of this. If you look over the past couple of years, and the past couple of years really is the relevant history of this company, given the new industry dynamics with Apple and Google Pay or Google Wallet, whatever the case may be. There's new remittance companies. There's Wise and Remitly, which, by the way, they're not small businesses. They're each, I think, $10-15 billion market cap companies. Compared to PayPal 60, they're very, very sizable opponents, and they're growing 30% year on year. So, of course, that was never like a main business for them, but it's definitely like a nice to have business of sending money cross border. I'm sure it's a very high margin sort of business for PayPal. And so this is the issue that you're going to start to face here, is that this company is now in outright decline. What if this trend keeps up? What if over the next couple quarters, it goes severely into the negatives? It goes -4, -5, -10% year-on-year declines. Because frankly, even though we have KPIs here, like the active accounts, sure, the active accounts are growing as a whole, but in the same time frame, do you know what's declining for them? The total number of transactions. Yeah, there's more people on PayPal, but in aggregate, everybody combined, they're transacting less with PayPal, and by a pretty significant margin. At the same time, you have the average take rate across the business, because they own PayPal, they own Venmo, they own Braintree. That is also starting to decline. Of course, a huge portion of that is because of the Braintree side of the business having a very, very low take rate, because it's like a white label payment service provider. It still stands. You have a business that the revenues of that business they're just not growing anymore because of the reasons I outlined. So ultimately, the 7-8% earnings per share that you're going to brag about, the free cash flow per share, whatever profitability metric you're looking at, that is a result of the company making, call it $100 in revenue. However much of that flows over to profits, they put 100% of that back into buybacks, and that is somewhat artificially boosting the true profit growth that this business is actually expected to have. If you look at net income growth, once the data comes out this quarter, I would assume, I don't know off the top of my head, I would assume it's close to 1%, right? Or maybe even lower. Maybe it's also negative, like the revenue number. So ultimately, the business, and this is the point I'm trying to make, if you exclude out buybacks, which of course that's happening, whatever the case is, if you exclude those out, the actual business in of itself is in decline. This is fact. Of course, they can turn around. They could create new business segments. That's the current talk of it, that they're going to be this platform for small to medium-sized businesses to do all commerce on. And of course, the new CEO, he's from Intuit. He's a great CEO. I've listened to plenty of his interviews. He's supposedly coming from Intuit, having that SMB tilt, and he's going to be creating these new business segments to re-accelerate revenue growth and turn around the business. Again, it's just such a difficult thesis. Why are you, as an investor, when Google trades at 16 PE, and I'm sure that has, that has the difficulties of their business and their issues, capex risks and so on and so forth, why are you as an investor betting on PayPal? They trade at the same valuation. You have one company that currently is not growing, with the trend definitely not in your favor here either. It's declining. At the same time, culturally, we're seeing PayPal fade away. At the same time, you have new competitors popping up that are basically doing it for free, particularly in the US. If you want to peer-to-peer transactions, if you want to send money peer-to-peer, you have Apple, you have Zelle, you have a bunch of different choices. Remittance, we already talked about that. On the checkout page, which is, the huge profit generator, we have Google Pay, which within a click auto-fills your entire credit card information. So that has eradicated a 3% take rate business for them, right? So overall, they're just in such a tough position. And this is a business that is dated by a good decade. This was a great business a decade ago. I think the revenue growth and the gross payment volume growth and all those metrics, I think it's very evident of that. But ultimately, now that I actually think about it, between this and Starbucks, I'm probably more confident in the Starbucks turnaround, even though they had awful results, terrible results. I'm probably more confident in that turnaround than I am PayPal, because Starbucks at the end of the day is a great brand and they have a great CEO who's had the track record and that type of stuff. Whereas PayPal, sure, they have the great CEO, but competitively, they are so disadvantaged. They have a good bit of innovator's dilemma with, obviously, they're not going to cut their take rate to zero with branded checkout or whatever the case may be. Whereas Google Pay, it literally does not matter to them to offer that service for free. It's just another component of the ecosystem. So it's just a very, very tough position that PayPal is in. I would never endorse a certain decision for you as a shareholder if you're invested in PayPal or you're thinking of investing in PayPal, but I would seriously weigh the options, whether you're at a loss or whatever the case may be. Seriously take a look and assess the business in its current state, given all the troubles they have at the valuation that they're at currently. Is it really worth the headache of holding this business for the next handful of years? Even if the valuation expands to like a 22 PE like it did, right? So from here, it went from $60 per share or $50 per share to, I believe it was over 90 per share, but it was simply a move of valuation, and that can happen again. But are you really willing to bet on that? And I'm not going to answer that for you. That might be different for some people. Maybe they're like, you know what? I have this thesis. I believe that maybe they can spin up new business lines, whatever the case may be. That is for you to decide. Point still stands. Google trades at a 16 PE, so does PayPal. Do the opportunity cost calculation for yourself and make the decision there. And ladies and gentlemen, with that, I'm going to end it off here. If you want to come hang out with me, I have a Discord, which is linked in the description down below. And additionally, I do exclusive videos such as big hour-long deep dives and that type of stuff. This week and probably next week, I'm going to be doing more earnings-focused stuff, as I did with this one last week. So if you like the breakdown today, you want more content on basically all the big companies, like last week, I think I did 7 or 8 of them in this video right here. Go ahead, check out the Discord in the description down below. Come hang out with us. There's exclusive videos there. We have, I believe, over 250 different members. It's a lot of fun. I mean, just looking at the list here for this week, I haven't decided if I'm going to do like a dedicated meta or just a big tech video altogether, because everybody's going to be making those videos. But I'm thinking some of the lesser known companies. Like I'd be curious to go over the Domino's earnings, Cadence, that's a chip company. Booking, I'm absolutely going to be going over Booking. I'm absolutely going to go over Snap, maybe Visa. So like there's a couple interesting ones here that I'd be interested to go over. Additionally, you have McDonald's on Thursday, so that is sort of an interesting one. Airbnb, definitely going to go over that as well. So a couple of these interesting videos, these interesting earnings that I'm just curious to like keep up with the companies. I'm not going to make a dedicated video out of them. I'm going to put them into that exclusive video. Spotify's another great one, but yeah, there you have it. Thank you for watching all the way through. Don't forget, FinChat, 25% off. You have 8 days out of the year to take advantage of a sale like that. I suggest you at least take a look at the software. There's only one sponsorship I take on a channel, and there's a very good reason for that. Again, link in the description for that if you want to check that out. Thank you for watching, and have a good day.